China has been the UAE's largest trading partner for several years, with the UAE serving as China's largest export market and second-largest trading partner in the Middle East. Investment between the two nations has also grown significantly. Chinese investments in the UAE increased by over 16% in the past year to reach $1.3 billion, while UAE investments in China surged by 120%, accounting for 90% of all Arab investments in China. Implications for U.S.-China energy trade. China's deepening energy cooperation with Russia and Iran carries consequences for its trade in U.S.-sourced energy. The availability of cheaper crude from sanctioned suppliers gives China economically appealing substitutes, potentially lowering its dependence on U.S. oil. Geopolitical considerations also play a part, as Beijing strives to diversify its energy pool and reduce exposure to Western diplomatic pressures. Geopolitical and economic considerations. China's ties with Russia and Iran extend beyond energy, involving broader political and commercial strategies. By fortifying alliances with these states, Beijing seeks to offset Western influence and enhance its autonomy. This strategy aligns with its Belt and Road Initiative, designed to broaden China's global reach through infrastructure ventures and trade deals. Impact on U.S. economy. A slump in Chinese demand could leave surplus oil in U.S. markets, possibly depressing domestic crude prices. That scenario might reduce revenue for American producers and curtail both investments and job creation in the sector. Furthermore, if lower exports to China persist, the U.S. trade gap could widen, influencing other economic indicators. Mounting geopolitical frictions and policy tensions further color these trade patterns. The protracted U.S.-China tariff conflict, marked by levies and trade barriers, has spurred China to diversify its sources, thus decreasing its reliance on American crude. This realignment underlines the complex bond between international policy and economics. China's oil import trends. China's import arc highlights its dramatic economic expansion and growing international reach across 4 decades. Once a net exporter in the early 1980s, it evolved into the world's top crude importer, a transformation powered by broad industrialization, energy policy maneuvers, and geopolitical drivers. The turning point emerged in the early 1990s, when China switched from a net exporter to a net importer in 1993, propelled by sweeping economic reforms and a manufacturing surge that boosted domestic consumption. Output from places like Dorking couldn't meet the skyrocketing need, prompting overseas sourcing, initially from Southeast Asia. By the early 2000s, China's energy appetite soared amid its WTO entry in 2001 and an economic boom shaped by manufacturing and infrastructure growth. Import levels climbed steadily, exceeding 4 million barrels a day by that decade's end. Pipeline and refinery developments followed, priming the nation for even heavier oil inflows. The 2010s saw record-breaking gains in China's import volumes. By 2017, it had surpassed the U.S. as the biggest crude importer, driven by industrial demand and a burgeoning consumer market. Supply diversification accelerated, reducing reliance on Middle Eastern oil through greater uptake from Russia and parts of Africa. By decade's close, imports hovered around 10 million barrels daily, underscoring its central presence in energy markets. While the 2020 pandemic disrupted global economies, China's oil imports generally held firm, averaging roughly 11 million barrels daily, thanks partly to strategic stockpiling during price crashes. Subsequent years saw demand fluctuations from COVID-19 effects, yet imports still peaked at 11.3 million barrels per day in 2023 amid a sturdy rebound.